Let me ask you something. What if I told you that someone making an average salary, not a CEO, not a crypto genius, not a trust fund baby, just someone saving $500 a month, could quietly build $1 million? No lottery, no trading all day, no get rich quick nonsense, just math. And here's the crazy part. Most people who hear this either 1. Don't believe it. 2. Think it takes 100 years. 3. Or say, yeah, but that won't work for me. And that reaction right there, that's why most people stay broke. Picture this. You wake up, you check your bank account. Your paycheck just hit. For about 10 seconds, life feels good. Then, rent, phone bill, subscriptions, groceries, transport, small weekend spending. And suddenly that paycheck, gone. You tell yourself, next month I'll start saving. But next month becomes next year. Look, that's exactly how normal life works. And that's exactly why wealth feels impossible. But here's what most people don't realize. Wealth is not built with huge money. It's built with small money done consistently. And today, we're going to break the math so simply, you won't be able to ignore it. Here's the lie most people believe. You need a high income to get rich. That sounds logical, right? But statistically, it's false. According to data from studies referenced in books like The Millionaire Next Door, many millionaires are not flashy high earners. They're consistent investors. The truth? Income helps, but behavior builds wealth. And that's where $500 a month becomes dangerous. Let's remove emotion for a second. Let's just do math. $500 per month equals $6,000 per year. If you invest $6,000 per year and earn an average 8% annual return, historically close to long-term broad stock market averages, how long do you think it takes to reach $1 million? 50 years? 60? No, around 35 to 40 years. And this is where it gets really interesting. The majority of that million does not come from your money. It comes from time. Quick pause. This video is for entertainment and educational purposes only, not personal financial advice. I'm showing you math and historical averages, not telling you what to invest in personally. Now, back to the part that changes everything. Here's what most people don't realize. The first 10 years feels slow, painfully slow. Let's say you start at age 25. After 10 years of investing $500 per month at 8%, you'd have roughly $90,000 to $100,000. And so people look at that and go, that's it? I invested $60,000 total and only made about $30, $40K? This is where people quit. But quitting here is like leaving the gym right before results show, because the real growth happens later. From year 25 to 30 of investing, that's when things get crazy. By year 30, you're around $680,000 to $750,000. By year 35, you're crossing $1 million. And here's the shocking part. In the final 5 to 7 years, your money makes more per year than you do. Read that again. Your money starts working harder than you. That's when the shift happens. The problem isn't math. It's psychology. Humans are terrible at valuing long-term rewards. There's something called present bias. We overvalue today. We undervalue 30 years from now. $500 today feels powerful. $1 million at 60 feels abstract. So we choose today, again and again and again. That's not stupidity. That's wiring. But once you understand it, you can beat it. Now you might be thinking, okay, but I don't even have $500 extra. Fair. Let's break that down. $500 per month is about $16 per day. That's daily food delivery, random online shopping, upgraded lifestyle creep. I'm not saying cut all joy, but here's the uncomfortable truth. Most people don't lack income. They lack intentional allocation. Big difference. Let me tell you about two friends. Same age, same salary. Friend A spends everything but upgrades lifestyle every raise. Friend B invests $500 per month automatically. No emotions involved. After 10 years, they look similar. After 20, friend B has options. After 30, friend B has freedom. Friend A has memories. Now which one feels richer? Compound interest is like planting a tree. Year one, it's a stick. Year 5? Still small. Year 15? Now it gives shade. Year 30? It's an ecosystem. Most people dig up the tree before it grows. That's the tragedy. Let's zoom in deeper. At 8% average return. Year 1, small growth. Year 10, momentum. Year 20, acceleration. Year 30, explosion. Roughly 70 to 80% of the final million comes in the last third of the journey. That means patience is not optional. It's required. According to long-term historical data of broad U.S. stock market returns, like S&P 500 averages, returns around 7 to 10% annually have been common over multi-decade periods. But here's what scares people. Markets crash. Yes, 2008 happened. 2020 happened. Corrections happen regularly. But historically, markets recovered over time. The people who panic? Lose. The people who stay consistent? Win long-term. This is where discipline beats intelligence. Here's the thing. Nobody posts on Instagram. Just invested $500 again. It's boring. Wealth building is boring. But being broke at 60? That's stressful. Pick your boring. When you invest monthly automatically, something changes. You stop asking, can I afford this? And start asking, is this worth slowing down my million? That mental shift? That's power. Now here's what gets wild. What if instead of $500, you invested $700 or $1,000? The timeline shrinks dramatically. $1,000 per month at 8%, you could cross $1 million in closer to 25 to 30 years. Time plus contribution equals speed. That's leverage. But here's what most people don't realize. The real power isn't the million. It's what happens before the million. At $300,000, at $500,000, at $700,000, you gain options. Switch careers. Start business. Or work less. Negotiate from strength. Wealth buys freedom before it buys luxury. And that's the part nobody talks about. So now you understand the math. But here's the deeper question. Why don't more people do it? If it's simple math, why isn't everyone a millionaire? That's where psychology destroys math. We're going deeper now, because the math is simple. But the behavior? That's where everything breaks. So here's the uncomfortable truth. Most people don't fail because the strategy doesn't work. They fail because they stop. Usually in year 3, sometimes year 5, almost always before year 10. And why? Because it feels like nothing is happening. Let's be honest. If you invest $500 a month, and after 1 year you have maybe $6, $500, $800, you don't feel rich. You feel unimpressed. This is where it gets really interesting. Human brains are reward-driven. We want visible progress, fast progress, like weight loss in 2 weeks, like viral success in 3 videos. But compounding? Compounding hides its power. The first phase of wealth building is invisible. You're building habits. You're building discipline. You're building identity. And here's what most people don't realize. Before you become financially wealthy, you become behaviorally wealthy. That means you stop impulsive spending. You think long-term. You tolerate boredom. You detach from lifestyle pressure. That transformation alone already puts you ahead of 80% of people. Now, let's talk about the silent killer. Lifestyle inflation. You get a raise. Instead of investing more, you upgrade your phone, your car, your apartment, your vacations. Look, I'm not anti-enjoyment. But here's the math nobody calculates. If every raise increases expenses instead of investments, your future self never benefits. Your future self stays stuck at the same financial level. You just upgraded your cage. That's harsh, but it's true. Now you might be thinking, what if I invest for 10 years and the market crashes? Good question. Let's zoom out. Historically, markets have crashed many times. 2000, dot-com crash. 2008, financial crisis. 2020, pandemic crash. And yet over long periods, markets have historically trended upward. This isn't optimism. It's historical data. And here's the twist. When you invest monthly, market crashes are actually discounts. You're buying assets cheaper. But emotionally, it feels like disaster. This is where psychology fights logic. There are 2 investors. The emotional investor checks portfolio daily. panics during dips, stops investing in fear. The rational investor understands volatility, keeps investing, thinks in decades. Guess who becomes the millionaire? Not the smartest, the most consistent. That's it. Here's an actionable step. Automate your investments. Not, I'll invest if there's money left. No, invest first. Spend what remains. That single shift changes everything. Because willpower is unreliable. Systems are reliable. And wealth is built on systems. Let's break down $500 psychologically. If you earn $3,000 per month, that's about 16 to 17%. It feels big, but what if instead of cutting joy, you increase skill, increase income, negotiate salary, start a side skill? Here's what most people don't realize. Increasing income by $500 is often easier than cutting $500 forever. Growth mindset beats restriction mindset. Imagine a graph. Flat, 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 then suddenly up. That curve? That's exponential growth. Compounding doesn't reward early excitement. It rewards late patience. And this is why most people never experience the up part. They exit during flat. Let me show you something powerful. Starting at 25 with $500 per month versus starting at 35 with $1,000 per month. The 25-year-old often still wins, even investing less monthly. Why? Time is leverage. Time multiplies. Money adds. Time multiplies. That's a huge difference. Now, let's address something else. $1 million sounds magical, but at 8% annual return, that's roughly $80,000 per year before taxes. That's income without working. Let that sink in. The million isn't about flexing. It's about income independence. That's the real goal. Here's what changes when your investments grow. You stop tolerating bad environments, bad bosses, bad opportunities, because you're not desperate. Money doesn't change who you are. It changes what you tolerate. And that is powerful. Now you might be thinking, I'm already 35. I'm already 40. Look, is starting at 25 ideal? Yes, but starting at 35 is infinitely better than starting at 45. Compounding is powerful, but procrastination is expensive. Every year delayed costs more than you think. Let's say you wait 10 years to start. That delay could cost you hundreds of thousands in final value. Not because you invested less, but because time stopped multiplying. Waiting is the most expensive financial decision people casually make, and they don't even feel it. Here's what most people don't realize. Investing consistently changes your identity. You stop seeing yourself as someone trying to survive. You start seeing yourself as someone building assets. That identity shift changes decisions. You read differently. You think differently. You choose differently. Wealth starts in identity before numbers. Let's make this practical. Step 1. Track every dollar for 30 days. No judgment, just awareness. Step 2. Find $200 to $500 that can be redirected. Step 3. Open an investment account, low-cost index approach historically common. Step 4. Automate monthly contributions. Step 5. Increase contribution every raise. Simple, not easy, but simple. Let's consider this wealth formula. Income times savings rate times time times return times behavior. Notice something? Behavior is last, but behavior controls all of it. Without discipline, the math collapses. Nobody gets excited about 7 to 8% returns. It sounds average, but average compounded over decades becomes extraordinary. And that's the paradox. Extraordinary results come from ordinary actions repeated long enough. Your friends may upgrade cars, post vacations, show lifestyle. Meanwhile, you're investing quietly. It may feel like you're behind, but here's the twist. In 20 to 30 years, the roles reverse. Short-term applause or long-term freedom. Choose wisely. If you're 25 and invest $500/month, you're not buying stocks. You're buying options. If you're 30 and start today, you're not late. You're early compared to most. If you're 40, you still have decades. The only truly bad decision? Never starting. Imagine 30 years from now, two versions of you. One who said, I'll start next year, and one who said, I start now. Which one sleeps better? Which one negotiates from strength? Which one lives without fear of bills? That's what this is about. Not the million, the peace. $500 a month. That's not magic. That's consistency. That's discipline. That's boring commitment. But over decades, it becomes $1 million. And here's the part nobody can ignore anymore. If you don't build assets, you will build dependence. On a job, on a system, on luck. And luck is not a strategy. So here's my challenge to you. Not tomorrow, not next paycheck. Today, decide the number. $200, $300, $500. Automate it, and don't touch it. Let time do what humans can't. Multiply quietly. Look, the math is simple. The psychology is hard. But once you understand both, you stop saying, I hope I'll be wealthy. And you start saying, I'm building it. $500 a month. Done consistently. With time, turns into $1 million. Not because it's exciting, but because it's inevitable if you don't quit. And that is the real secret.